Okay, and welcome back, students who are taking financial accounting, and in this series of videos we are working on the chapter 4 short exercises. I'm going to just quickly jump down here to the next problem. I want you to realize that we just finished off problem 4-7, and it's important. If you didn't watch 4-7, short exercise 4-7 in the previous video, when you're working through this problem, I actually started working on this problem and I stopped the video and I'm starting again because I thought of a different way of presenting this information that would be a little bit easier, all right? But the first part of this problem here says, suppose Peters Hardware sells merchandise on account, 2% 10 net 30 for $640, and the cost of the merchandise inventory was $360. Well, I'm not going to go through the explanation of how to make those journal entries, all right? I'm going to make them so that you see them, but the thought process is in problem S4-7 there. So go back to the previous video and watch those if you don't get it. And that leads me to the point of, you're watching me do this from an application standpoint. The application part generally is not the problem. It's generally the concepts, okay? And this problem is, steps up the degree of difficulty because now we're adding in a sales return. All right. Whereas in the previous problem, we didn't. I mean, this previous problem, here was the purchase, and then we received the payment. Well, now here we are making a purchase, then we're having a return, and then we're paying it off. Okay. So the degree of difficulty. Okay, what's going on here? I don't know why that moved. Let me see here. Sorry about this, but I don't know why. Okay, there we go. The degree of difficulty is stepping up here, right? So I'm not going to go and explaining, the stuff from the previous video. Go back and watch that video in order to get that theory. And the point also being is that if you don't understand the theory, go back and watch the theory videos. But if you still don't get it, then contact an instructor. So this problem here says, suppose Peters Hardware sells merchandise on account and it gives terms for $640 and the cost is $360 on March 17th. And then later, Peter received $185 of goods with a cost of $110 as a return on March 21st. So from a timeline perspective, this is 3/17 and he's making a purchase. Okay, then on 3/21 there's a return. Okay, the customer paid the balance due on March 26, so 3/26 there's a payment. Right, journalize the transactions for Peters Hardware. Realize that all transactions happen in what I like to call moments in time. Okay, and I kind of covered this in the theory videos for Math for Business and Finance in the first videos. If you had watched those, in that transactions happen in time, and it's oftentimes good to create a timeline so that you can understand what you're doing at any moment in time. Okay, and as the moments in time pass, that's the way you're making your journal entries based upon the transaction. So here I have 3/17 I have to make journal entries, then on 3/21 I make them, and on 3/26 I have to make them, and each one is predicated upon the other. Okay, now so let's look at what it is that we have to do here. All right, so on 3/17, and making the timeline is just a way to be able to organize my thoughts, okay, to understand what's going on when it's going on. So on 3/17, it says I'm selling merchandise on account for $640. So that means I'm going to debit accounts receivable for $640, and I'm going to credit my sales revenue for $640. Now what I'm going to do is I'm going to create T accounts here in order to be able to sort of I mean, the purpose behind T accounts, they're just a tool for you to be able to see and understand what you're doing. Okay, so I'm debiting my accounts receivable for 640, and I'm crediting my sales revenue for 640. And like I said in the previous exercise 4-7, whenever you make a sale, okay, that you also have to make an entry because you're selling something. When you're making a sale out of inventory, I should say, you also have to make a second journal entry. So this is journal entry like number 1, right? But I have to make a second entry because why? Because I have an inventory account, okay, and I have a cost of goods sold account, and I have, regardless of whatever the beginning balance is here in my inventory, that's irrelevant, right? Because all I'm doing is just figuring out what's going on with my inventory account. It doesn't matter if I have 100,000 or 200,000 in that account. What I'm doing is I'm selling something out of the account, okay? So since I made a sale for 640 and it tells me that my cost on that inventory is 360, right? I'm taking 360 out of the inventory account. Well, the normal balance of an inventory account is a debit, so that means I have to credit my inventory account for the 360, and since debits have to equal credits, I'm going to debit something else, and that means I'm going to expense it to cost of goods sold for 360. Okay, so I have a credit for 360 here and a debit for 360 here. And if you didn't understand what I just did with these two entries, like I said, go back to problem S4-7 and watch that video that has the explanation for why I did what I did. Okay, so I use these T accounts to show, I put them in. This represents, these T accounts represent my posting of this journal entry to the ledger accounts, right? So I'm going to erase all of this. I don't need it anymore because the information is in my T accounts, in my general ledger accounts. Okay, so now I'm up to March 21st. So I have entries for March 21st. And it says here, Peters Hardware later received $185 of goods as sales returns. And the cost was $110. Well, what's happening here? Okay, if I'm receiving the $185 of goods, that means it's being, and it's sales returns. That means it's being returned. And remember from the previous videos, you look at your chart of accounts, and if all you have is just a sales account, a sales revenue account, then that's all you use. But a lot more businesses will have a sales revenue account, a sales discount, and a sales return and allowance. And then the difference between those, because remember, the revenue is a credit, the discount is a debit because it's a contra account, and the return and allowance is a contra account. The difference is your net sales revenue. Okay? So depending upon how your chart of accounts looks, will determine what you're doing. But we're kind of like, you can make an argument and say, well, I used my, like let's say this was a test question and you said, you went and you put it to sales revenue, okay? You would get it marked wrong because it's telling you that as sales returns, which means I should be debiting my sales return and allowance account for the 185. And of course I have to credit something else. And what am I crediting? Okay, well, I'm crediting my accounts receivable. Why? Because they don't owe us the $185. They don't owe us a full $640. They owe us $640 less the $185 that they returned. So I credit my accounts receivable for $185, and now I have to create another T account, sales return and allowance, and that has a debit of $185 in it. Okay, but just like when I made the sale, if I had to make one entry for the sale and the second entry for the effect on the inventory, whenever I have a return, I have to do the same thing. I'm, when you're returning, think of it as like a credit, for your account. You're reversing your revenue account, you're reversing the sale. So that's one, but now you're also affecting your inventory account because why? You have this merchandise back and you have to put it back into the inventory account. Okay? And it tells us that the cost is $110. Okay? So if I had a credit of 360, right? Because I made the sale. Well, if it's coming back, then the opposite of that is a debit to inventory for the $110, which is the cost, and I'm going to credit my cost of goods sold account for $110, right? Right, so that's my posting there. Remember, all we're doing is we're just kind of like reversing our two entries that we made for the sale, with the only difference being is that instead of using sales revenue, we're using the sales return on allowance account. Okay, so that takes care of the transactions for what happened on 3/21. Now we're up to 3/26. Right, the customer paid the balance due on March 26th. Right, now the question is, are they within the terms? 2% 10, right? Well, the original purchase was on 3/17 and they're paying it on 3/26, which is 9 days, so they're falling within the discount amount, so they're going to get a 2% discount that they don't have to pay, right, for the terms. So it says the customer paid the balance due on March 26th and journalize the transactions. Okay, so what is owed here? Okay, well, if they're paying off what they owe, they're paying off their accounts receivable. So we know we're going to credit our accounts receivable for some amount. Okay, and we know we're going to get cash, so we're going to debit cash for some amount, right? But the question is, for what amount? Right? So let's look at it. Okay, for our accounts receivable, what's the difference that they owe? Well, 640 less 185 is $455, right? Because that's the balance in the account, 455, right? So we'll credit the accounts receivable for $455. Now, from a cash perspective, all right, they're not going to pay the $455. They're going to pay the $455 less the discount, right? And how much is the discount? Well, the discount amount is 2%. So 2% of $455 is $9.10, right? So if we take $455 and subtract $9.10, we end up with $445.90. So that's how much they're going to pay in cash. So we're going to receive $445.90 in cash. Now, remember, debits have to equal credits, and obviously these aren't equal, and they're not equal by the amount of the discount here of $9.10. So to get to our accounts receivable, I have to debit, and I'm going to debit my sales discount account for $9.10, and so my journal entry balances. All right, and that's the end of that transaction. So when I look at everything as it's all said and done, now I'm going to add a sales discount account here, right? And what do we have? All right, I have a credit to my accounts receivable for $455, so I'm going to post the $455, and now the net balance in my receivable is 0. Okay, I have a cash account, right? Because now I'm going to receive cash, and I'm receiving $445.90, right? And I also have a debit to my sales discount of $910. So what are we looking at all together here, right? Well, what we're looking at here is, let's take a look at our inventory accounts first, all right? Our inventory account has a balance of 250, right? And our cost of goods sold has a balance of 250, right? So we took out 250 out of our our inventory and we moved it to our cost of goods sold, right? Notice that that debit equaled that credit between those two different transactions. You know, we're paying cash. Well, what do we have for sales? Because remember, when you buy something for cash, you're going to debit your cash. I mean, when you sell something for cash, you're going to debit your cash and you're going to credit your revenue account. And, you know, that's one transaction. But if we sell something as on account as an accounts receivable, well, we're going to debit the receivable, credit the revenue account, and then when they pay off the accounts receivable, we're going to credit the receivable and debit our cash. Okay, so that our receivables wash each other out, and all we're left with is the debit to cash and credit to accounts receivable, which is the exact same thing as if they paid for it in cash in the first place. Okay, so what are we looking at here? We're looking at our sales revenue of 640, and there was a return of 185. Okay, and there was a discount of 910. Okay, so when you take 640 less 185 less 910, your net, and the word net is the important part of the concept, net sales revenue ends up being 445.90, okay, which is how much was paid in cash. So when we take into consideration the revenue less the returns allowance less the discount, you know, that is the net effect of our sale, 445.90, which is how much we ended up paying in cash. Okay, and so that's the complete concept. And like I said, you know, you can follow along in the application of it. All right, if you made a mistake in doing the math somewhere or putting it in the wrong spot, that's the application, and you pick that up from this video. But if you're not understanding the, you know, any of the concepts here, you need to go back to the previous videos or watch this, you know, again and again. I mean, some of the stuff I skipped over because it was, you know, covered in other videos. So with that said, I'm done. And if you still have any other questions after watching the other videos, you know, feel free to contact an instructor. I mean, that's what we're here for. Okay.